Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, August 12th, 2024. So last week when we did our podcast, we mentioned the fact that we were in the middle of a very tough day for equities here in the US. And also mentioned that the previous week we saw some volatility that we really haven't seen this year, and quite frankly, really not since COVID in terms of volatility levels. Well, at that point we argued what appeared to be going on was a serious overreaction to one data point that came out a week ago, which was a non-farm payroll number, which was far lower than expected. And not taking a victory lap here, but looking back since that point last week, Monday, things did stabilize here in the US. The equity markets actually rebounded from last Monday, finished the week flat. So things feel a lot better at this point. So we're not really sure what happened the previous week. We know it did have something to do with the Japanese market, carry trade, Japanese central bank raising rates. But here in the US, the only thing we could really point to was a non-farm payroll number that was definitely weak, but shouldn't be all that big of a surprise. So anyways, things normalized a little last week. We'll take a look at some of the data that we had last week, very little, take a look at results, and then look at this week's economic data, which there is far more going on this week. So last week, only two pieces of economic data worth mentioning. The first was last week, Monday, the PMI, the services PMI. Like manufacturing, both are scaled at 50. So anything above 50 means expansion, anything below 50 is contraction. So that came in for the month of July on the services end, positive, above 50. It came in at 51.4 versus a 51 expectation. So it was solid. Later in the week on Thursday, we did get the initial claims number. Now, 2 months ago, no one was really watching this number, but now people are very focused on unemployment claims. So expectation for the prior week is that we would have seen 240,000 new claims, came in at 233. So that was a positive surprise. And again, I think helped investors feel a little bit better. So those were just the two data points. So taking a look at takeaways from last week. One, the Atlanta Federal Reserve continues to think the U.S. economy is performing at a very high level. So remember, second quarter GDP growth was 2.8% in the U.S. Most economists were below 2, but the Atlanta Federal Reserve was at 2.9, so they pretty much hit that. Their expectation for this quarter, Q3 of 2024, they revise this every week, but the revision last week was up a little bit to 2.9% for the quarter. So that's really strong. In terms of inflation expectation, when we take a look at the 10-year break-even, 10-year treasuries minus 10-year tips, that went up a little bit last week, 6 basis points, but it's still at one of the lowest levels we've seen since COVID started, really, at 2.1%. So that's the expected, built-in expectation of average inflation for the next 10 years. Also, let's take a look at Fed funds future. Now, this is fascinating. Again, things were flipping around pretty quick last week, and we mentioned the overreaction. We kind of think the overreaction actually carried through expectations on how the Fed was going to approach this new issue. And in fact, last week there was significant speculation the Fed was going to step in and do an interim meeting and cut rates immediately. Didn't happen. And so therefore, here we are on Monday, next week, people are expecting the Federal Reserve to be much less aggressive than they were only 1 week ago. So now the expectation is, it was pretty much locked in that we would get 2 rate cuts in the September 17th meeting. That was 85% probability as of a week ago. That's dropped to under 50%, to be precise, 48.5%. So expectations for cuts in September down dramatically from just a week ago. And then if we take a look at the end of the year, so last week we mentioned that it looked like there were 5 rate cuts that were priced in. Currently now, the odds are 4, that we will get 4. That's 72%, but that's down from 95.3% the prior week. So the takeaway from that is expectations for the Fed coming to the rescue and cutting interest rates. Still there, but it dropped dramatically week over week. So the last thing from last week, we're concluding the second quarter earnings releases for S&P 500 companies. So to date now, 91% of companies have reported, 78% have reported beats, so that's above the 5 and 10-year average. Now, the actual expectation now for second quarter, when it's all done, earnings growth year over year actually dropped last week. So the prior week it was at 11.4%, it dropped to 10.8%, kind of a technical factor. One company, Warner Brothers Discovery, last week took a $9 billion write-off through their income statement, and that alone depressed the aggregate S&P 500 earnings expectation for second quarter. But bottom line is, second quarter we're expecting to finish at a positive 10.8% year-over-year growth. When we came into the quarter, that expectation was 8.9%. So corporate earnings definitely strong and driving what strength we have seen in the S&P 500 year to date. So let's take a look at what we've seen in terms of returns last week and year to date. S&P 500 flat last week. In fact, most of the U.S. indexes on the equity side very much around the flat line, which was welcome given the prior week. So now for year to date, S&P 500 is up nearly 13%, 12.96. The NASDAQ, actually, that's a little lower. That's 11.55 on a year-to-date basis. So what we've seen on a year-to-date basis is that rotation from the Magnificent Seven and some of the other tech names to value names. So within the U.S., value is now outperforming growth on a year-to-date basis. Value up 9.4%, growth up 6.5%. Now again, last week I said most of the U.S. index is pretty much flat. Same for the international. Developed markets ex-U.S. down 12 basis points. Emerging markets up 21 basis points. So hardly any movement in equities, a lot during the week, but point to point, pretty flat week over week. Now fixed income, we've mentioned the fact that fixed income had an amazing rally here in the U.S. over the prior 3 weeks. Gave some of that back last week. So last week, the 2-year yield increased 17 basis points. The 10-year was up 15 basis points. So the Bloomberg U.S. Aggregate Bond Index fell 82 basis points last year. Now, year to date, Bloomberg U.S. Aggregate Bond Index is up about 2.4%. So still a solid showing, but gave up a significant portion of the gains just last week. So I mentioned last week we had very little in terms of economic data that was released. Not the case this week. We've got a ton of them. We'll start off with tomorrow. We're going to start seeing inflation numbers. Tomorrow is PPI, both core PPI and headline PPI. So this is Producer Price Index. And the expectation is we're actually going to see some decrease from the month of June. So for July, the expectation is on a month-over-month basis, the core PPI is expected to be month over month plus 0.2%. Prior month it was up 0.4%. And the headline number month over month is expected to be up 0.1%. Prior month of June, it was up 0.2%. Probably the biggest news this week will be on Wednesday. So that's the CPI inflation rate, both core and headline number. And those are expected actually to be up from the prior month. So the month of June, the inflation rate, the headline number, month over month was down 0.1%. That's expected to be a positive 0.2%. And then in terms of core month over month, again for June, it was up 0.1%. The expectation is for July, it was up 0.2%. For the rest of the week, we get retail sales. That could be a big number. That's on Thursday. The expectation is actually an increase over what we saw in June. In June, we saw month over month flat. The expectation is month over month in July, an increase of 0.3%. Now, as I mentioned, initial jobless claims, something we hadn't been paying a lot of attention to, and we definitely are now. Initial jobless claims are expected to come in at 235,000. The prior week came in at 233,000. When we finish on Friday with building permits and housing starts, not much movement there. Both of these indicators for July are expected to be down slightly from what we actually saw in June. Nothing of real note. But the last piece of data, University of Michigan Consumer Sentiment, that will be released on Friday for August. It had come in at 66.4 for the month of July, And the expectation is just a very modest improvement, up to 66.7 for the month of August. So that's it for Economic Recap. We thank you so much for attending and hope to see you again next week. Thank you very much.